Welcome, market participants, to another Three Things in Credit. I'm Van Hester, Chief Market Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. Less transparency means more guesswork, more uncertainty, more volatility, more risk premium, more event risk. Oh, that's how Bob Michael, JP Morgan Asset Management's Chief Investment Officer and head of the Global Fixed Income, Currency, and Commodities Group, sees new Fed Chair Kevin Warsh's mission to reduce forward guidance. I can't say I disagree with Mr. Michael. More information beats the alternative. This week, our three things are 1. Rates versus oil. There's been a breakdown in the relationship. And 2. Critical thresholds. We're highlighting 3 worth watching. And 3. REITs versus BDCs. 2 peas in a pod, right? All right, let's dig a bit deeper. Rates versus oil. Now, no great surprise, as conflict in the Middle East unfolded, rates moved higher with the rising price of oil. After all, war is inherently inflationary, doubly so in this case as the conflict cut off 20% of the world's supply of oil. But something interesting happened in the wake of the most recent ceasefire. The price of oil fell, no surprise, but the movement in rates has been much more subdued. Over the past 2 weeks, the price of WTI has fallen 18%, while the 2-year U.S. Treasury yield has risen 3 basis points to 4.11. The 10-year U.S. Treasury yield has fallen by 11 basis points to 4.37. So either the oil market has gotten ahead of itself and is overly confident the strait will reopen quickly and fully, or the rates market is overly pessimistic. Or maybe something else is at work, like a new Fed chair coming out as more of a hawk than was expected. Well, that explains the front end selling off. The Fed funds futures market is now pricing in one hike over the course of the next 3 meetings, with a 1/3 chance of another by the end of the year. That roughly squares up with the latest dot plot. For those hoping a break in the price of oil would bring with it lower rates, well, those hopes have been doused. But that really was never going to be the case anyway, right? The longer end was always going to reflect a firmed up term premium due to fiscal concerns and the expectation for heavy Treasury issuance. But let's keep all of this in perspective. A 10-year bobbing around between 4 and 5% is hardly problematic. After all, in the decade before the financial crisis, the 10-year averaged 4.85, while the average growth rate in real GDP in the US was a healthy 3.1%. Is a 4.5% 10-year restrictive? Well, if we judge by today's housing market, you could make that case. But we've had mortgage rates north of 6% plenty of times in the past, so at a minimum, there is something else going on, like shortages of home building resources such as labor and home builder optimism, and overly restrictive zoning, and I'm sure other sources of friction. The point is, this level of rates is not overly restrictive in the aggregate in terms of growth. The real question is whether or not it is restrictive enough to contain inflation. All right, on to our second thing, thresholds. Now, at the risk of sounding trivial, if not juvenile, we've come up with a threshold sequence in the style of Herman Cain and Scott Bessent. For those who ask, who, when hearing Herman Cain, he was an American fast food executive who ran for president in 2012. His campaign was built around a 999 plan, featuring 9% corporate tax rate, 9% personal income tax rate, and a 9% sales tax rate. Cute, right? Well, it was catchy, boosting Kane's candidacy before he ultimately flamed out. Treasury Secretary Scott Bessent has a 333 plan, featuring cutting the budget deficit to 3% by 2028, boosting GDP growth to 3%, and increasing U.S. energy production to the equivalent of 3 million barrels a day. Well, I've got a 555 idea. Thresholds of 5 that, when crossed, suggest a material change in the investing environment is afoot. Without trying to be cute, the fives I keep track of are 1. $5 a gallon gasoline, 2. 5% U.S. Treasury yield, and 3. A 5% unemployment rate. On the gasoline front, $5 gas really doesn't move the needle in terms of consumer spending in the aggregate. But the spike, the trajectory, affects sentiment. So when we went from $3 a gallon prior to the Iran war to $4.56 quickly, it became a tax of sort that definitely hit lower earning households and oil intensive industries. The good news is that with talk of a peace agreement, gas has now broken through $4 a gallon on the downside. A 5% 10-year would also be a point of concern, even though the absolute level is not all that worrisome or unusual. By the way, the 10-year was averaged 485 in the decade prior to the GFC. Anyway, market participants have gotten used to ultra low rates in the decade post the GFC, and more recently have gotten used to a sub 5% 10-year since the great interest rate reset during and after COVID. Well, we did hit 499 in 2023, and markets sold off as narratives shifted to talk of bond vigilantes and higher for longer. Today, we've gotten used to a 10-year with a four handle. This is a highly constructive rate in terms of promoting two things. One, a quite reasonable cost of debt capital, and two, a high enough level to retain an essential level of capitalism's creative destruction. A 5% rate is not all that different, but a pronounced move through that threshold will then revitalize narratives that the high level of interest rates is crowding out private investment while burdening the less wealthy with higher auto and credit card rates. And a 5% 10-year would rekindle predictions, as it did back in 2023, that once it's breached 5%, it could go to 6%, etc. Well, that would not be good for credit. The good news is that we don't appear to be headed that way anytime soon. All right, on to our third thing, REITs versus BDCs. So, real estate investment trusts and business development companies are, in many ways, two peas in a pod. Both are pooled investment vehicles designed to pay out a high percentage of their income. Both invest in illiquid assets, real estate, and small to mid sized businesses, respectively. Both are reliant on the capital markets for funding. Both invest in illiquid assets, real estate, and small to mid sized businesses, respectively. Both are reliant on the capital markets for funding. Both are lowly levered. And both have been hit recently by technologically oriented shocks. REITs have been hit first by the surge in online retail that impacted the value of brick and mortar retail, and second by advancements in work from home capabilities, which called into question the value of office properties. Retail properties make up about 18% of the NAREIT Equity REIT Index. Office buildings account for another 3%. So, together, not a broadside hit given the diverse nature of commercial real estate property types, but a hit nonetheless. Meanwhile, BDCs have been impacted by concerns over the extent to which AI will disrupt the software sector, where some 20% of BDC loans have been lent. Again, BDCs are generally quite diverse in terms of their borrowers, but the concentration overall in software has brought selling pressure to the sector. Historically, REITs and BDCs are fairly correlated in terms of how risk investors view their stories. But that relationship has broken down over the past 6 months or so, where REIT equities have outperformed BDC stocks by some 28 points. And for comparison purposes, we are using the iShares Core US REIT ETF versus the Van Eck BDC Income ETF. And what's going on? Well, it's probably timing. Commercial real estate story has been unfolding now for some time, while the AI hitting software story is more recent and therefore has more uncertainty surrounding it, including unfamiliarity with investor redemption risk. But the more influential piece of this story is loan quality of the software sector. And on that point, I would encourage you to download KBRA's research piece, Private Credit Deep Dive on AI and Software, published March 27th, 2026. Among its findings is the following. We believe there is strong evidence that widespread AI-driven defaults are unlikely. You can find the piece on our website, kbra.com. So there you have it. Three things in credit. One, rates versus oil. Rates move with oil on the upside, but not so much on the downside. Term premium still matters. Two, critical thresholds. We're comfortably inside of all three of our fives, and that's good for credit. And three, REITs versus BDCs. The REIT story is ahead of the BDC story in terms of investor understanding, but the BDC narrative is better understood every day. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We'll see you next week.